If the United States ever truly stopped paying its debt, the global economy would not slowly stumble into crisis. It would slam into a wall. Within 48 hours, markets would seize up, banks would freeze their lending, and the dollars in your pocket would feel less like money and more like paper waiting for a price. It wouldn't look like a simple accounting error. It would look like a civilization-level software crash, because what we casually call U.S. debt is not just a big scary number in Washington. It is the invisible operating system that runs modern finance, from your mortgage rate to the cost of food in another country. When people hear national debt, they picture a bill that eventually has to be paid off. In reality, U.S. government debt is closer to a massive, constantly updated contract that the whole world relies on. It's the foundation on which other promises are built, and if that foundation ever cracked for real, the damage would not stop at the borders of the United States. It would be a global collapse in confidence, a sudden loss of faith in the basic rules of the financial game. To understand how dangerous that would be, we first have to understand how this system was created and why the richest country in history is also the most indebted one. The story starts in 1790. The United States was a newborn republic, victorious in war, but financially wrecked. It owed money to soldiers who had fought in the Revolution, to ordinary citizens who had lent savings, and to foreign governments that had backed the American cause. Most new nations in that position did what you'd expect. They defaulted, restructured, or simply refused to pay. The United States did something radically different. Alexander Hamilton, the first Treasury Secretary, made a bet that would shape the next 2 centuries. Instead of treating debt as a shameful burden, he treated it as a strategic asset. His argument was simple but revolutionary. If the new government could borrow and always pay on time, its promises would become valuable. Investors, at home and abroad, would want American IOUs because they were safe. Debt, if honored rigorously, would turn into a form of power. Under Hamilton's plan, the federal government assumed the state's war debts, issued new bonds, and made a point of paying interest in full and on time. These bonds were not bags of gold. They were pieces of paper backed purely by confidence in the new republic. But that confidence grew quickly. European financiers, who were used to monarchies defaulting whenever it suited them, noticed something unusual. This little experimental democracy across the ocean kept its word. Over time, U.S. debt became a premium asset on European markets. Holding American bonds was not just patriotic for Americans. It was profitable for anyone who wanted safety and a steady return. The United States did not only win independence with muskets and ships, it financed its growth by building a reputation. Faith in its debt quietly became faith in the country itself. That faith powered every major wave of American expansion. The canals and railroads of the 19th century, the factories of the Industrial Revolution, the New Deal's massive public works, and the staggering costs of World War II, all of it leaned on borrowing. Debt, in this context, was not a sign of failure. It was the fuel that allowed the country to invest in its own future faster than taxes alone would allow. By the middle of the 20th century, that engine was no longer just powering one nation. It was anchoring the entire global economy. In 1944, with World War II still raging, representatives from 44 countries met in a small New Hampshire town called Bretton Woods. Their goal was ambitious: prevent the kind of economic chaos that had helped create the Great Depression and fueled the rise of dictators. Their solution centered on the United States. They built a new international monetary system around a simple idea. The U.S. dollar would become the main global currency, and it would be convertible into gold at a fixed rate. Other major currencies would peg themselves to the dollar. In practice, that meant one thing: the value of money around the world now depended on trust in the United States, its economy, its political system, and most of all, its promise to honor its debts and its dollar-to-gold commitment. At that moment, the United States was uniquely qualified for this role. After the war, it held about 2/3 of the world's official gold reserves and roughly half of global industrial output. Its economy was intact, while much of Europe and Asia lay in ruins. Confidence in the dollar was absolute. Foreign governments and central banks began to hold dollars as reserves, and when they wanted a place to store wealth safely, they bought U.S. Treasury bonds. American government debt quietly turned into the world's savings account. but no system built on faith stays perfectly stable forever. By the 1960s, the United States was trying to do two expensive things at once: fight a long, costly war in Vietnam and fund ambitious social programs at home. Dollars flowed out of the country to pay for imports and military bases. Meanwhile, foreign governments, especially in Europe, began to worry. Were there now more dollars in the world than gold in American vaults to back them? Some of those governments started to demand gold instead of paper. They would bring their dollars to the U.S. Treasury and ask to convert them at the promised rate. Slowly but steadily, the gold stockpile began to shrink. The entire Bretton Woods system started to look fragile, a bit like a bank that still claimed to be fully backed, even as its reserves were draining away. In 1971, President Richard Nixon made a decision that changed the financial world forever. In a televised address, he announced that the United States would no longer convert dollars into gold. The dollar was temporarily taken off the gold standard, but that temporary move became permanent. Overnight, money was no longer tied to any physical commodity. Its value was based entirely on confidence. Confidence in the U.S. government, its economy, and its willingness to keep paying its debts. That shift created the world we live in today, a system you could call the debt standard. Gold no longer anchored the dollar. The anchor became something more abstract, but just as powerful: global trust in U.S. Treasury securities. It was a quiet revolution. For the first time, the United States could, in theory, create unlimited credit, as long as investors were willing to hold its bonds. Treasury debt became the safest financial asset on Earth, not because it was magically risk-free, but because everyone agreed to treat it that way. Once that consensus formed, the entire financial system reorganized itself around treasuries. Banks use them as top-tier collateral when they borrow from each other. Pension funds rely on them to balance riskier investments. Insurance companies hold them as a rock-solid reserve. Central banks around the world pile them into their balance sheets as the ultimate in-case-of-emergency asset. When you hear politicians argue about raising the debt ceiling, or news anchors talk about the national debt, they're not just talking about a government overdraft. They're talking about the core infrastructure on which modern finance is built. Almost every interest rate you encounter in daily life, your mortgage, your student loan, your credit card, is calculated relative to U.S. government bond yields. When treasuries are assumed to be perfectly safe, everything else in the system can be priced, traded, and insured on top of them. The entire machine depends on one simple ritual. When old bonds mature, the U.S. Treasury issues new ones, uses the new money to pay off the old, and the cycle repeats. The government almost never pays off its total debt. It rolls it over, continuously, decade after decade. As long as that rollover continues smoothly, the illusion of permanent stability holds. Investors get their interest, banks get their collateral. Governments and corporations around the world get a benchmark to build on. But the system also contains a hidden fragility. If that chain of payments ever breaks, if the United States misses even one obligation in a way that looks intentional or uncontrolled, the illusion shatters immediately. Treasury bonds are not just another investment. They are the base layer of the global banking system. A true default would mean admitting that the so-called risk-free asset wasn't truly risk-free after all. The effects would cascade with frightening speed. Within hours, liquidity would dry up. Large financial institutions would stop trusting each other's balance sheets because no one would know who was exposed to what. Stock markets would plunge, not necessarily because the profits of companies suddenly disappeared, but because the basic assumption that tomorrow will look like today would be gone. We have seen tiny previews of what that loss of confidence looks like. In 1979, a technical glitch in paperwork backlog caused the Treasury to delay some payments on maturing bills by just a few days. There was no dramatic announcement, no deliberate refusal to pay. But interest rates on those securities jumped, and the pricing disturbance rippled through markets for years. In 2011, political brinkmanship around raising the debt ceiling came so close to the line that a major rating agency downgraded U.S. government debt for the first time in history. Trillions of dollars in market value were wiped out in a matter of weeks, not because anything had fundamentally changed in the real economy, but because faith in the smooth functioning of the political system cracked. Those episodes were not traditional financial crises where banks suddenly discover huge hidden losses, They were psychological shocks. They reminded the world that the entire structure rests on a single assumption, that the United States will always pay, on time and in full, no matter how messy its politics look on the surface. That assumption has turned U.S. debt into America's most powerful export. Other countries ship goods, services, and raw materials. The United States, in addition to all of that, exports promises. Each Treasury bond it issues becomes part of another country's rainy day fund, another bank's regulatory capital, another pension fund's foundation. The rest of the world doesn't just tolerate America's debt. It actively demands it, because there is no obvious replacement. This is the paradox at the heart of American power. The United States does not need to eliminate its debt. In a sense, it can't. If the government suddenly tried to pay down everything it owed and stop issuing new bonds, it would drain safe assets out of the global system. Central banks would lose their main reserve instrument. Financial institutions would scramble for alternatives. The machinery built around treasuries would seize. In today's world, U.S. debt is not just a liability, it is the product. But even the strongest reputations can erode. By 2025, the official U.S. national debt had passed $38 trillion. The annual interest bill on that mountain of obligations was approaching $1 trillion, almost as much as the country spends on its entire military. The government was, in practical terms, borrowing money to pay the interest on the money it had already borrowed. The engine still runs, but the noise is getting harder to ignore. At the same time, domestic politics has turned the debt ceiling, a technical limit that Congress must periodically raise to authorize more borrowing, into a recurring hostage situation. Each time lawmakers threaten to block an increase, the world is forced to consider this once unthinkable, that the United States might default, not because it lacks dollars, but because it cannot agree on using them. Foreign investors notice. Major holders of U.S. debt, countries like China, Japan, and oil-exporting states, have slowly trimmed their treasury portfolios. Central banks, which once sold gold in favor of dollars, have quietly started buying gold again. Emerging market powers from Brazil to India have explored ways to settle trade without using the dollar at all. For the first time since the 1970s, the world's faith in U.S. debt shows hairline fractures. The issue is not that America is about to run out of money. It is that it might be running out of political consensus. And when faith is the only real backing for the system, politics becomes the biggest source of risk. So, what would it actually look like if the United States failed to pay its debt? It probably would not start with images of panicked crowds outside banks. It would begin quietly, maybe with a single missed payment on a treasury bill, blamed at first on a technical issue or a paperwork delay. A press release would reassure everyone that the problem is minor and under control. On the surface, most people would go about their day. But behind the screens, in trading rooms and central bank offices, everything would change. The unthinkable would have just happened. The safest borrower in the world would have failed, even briefly, to keep its promise. Algorithms that treat treasuries as risk-free would stop working. Risk models would have to be rewritten. Every institution that had assumed U.S. debt was the ultimate backstop would suddenly have to ask, what if it isn't? In the first hour, major financial markets would freeze. Treasury bonds sit at the core of countless transactions. They are pledged as collateral, used in short-term funding markets, woven into derivatives, and embedded in complex trading strategies. If they are no longer unquestioned, banks cannot safely lend, hedge funds cannot easily borrow, and market makers cannot be sure of their own positions. The plumbing of global finance would begin to seize up. Stock markets would tumble, not because factories stopped producing or people stopped working, but because valuations depend on discounting the future using interest rates and risk assumptions that all point back in some way to treasuries. When the benchmark is in doubt, everything built on top of it wobbles. The panic would then radiate outward. Foreign central banks that collectively hold trillions of dollars in U.S. debt would scramble to protect their balance sheets. Some would try to sell treasuries, pushing prices down and yields up. Others would rush into alternative assets, gold, other major currencies, maybe even large liquid cryptocurrencies, anything that looks less politically fragile in that moment. The dollar, once a symbol of stability, would suddenly look like a source of uncertainty. its exchange rate could fall sharply as investors try to reduce their exposure. Interest rates inside the United States would spike. Overnight, borrowing for everything from credit cards to auto loans to corporate bonds would become far more expensive. A government already running large deficits would find it harder to finance its operations. Within days, pressure would mount on federal agencies. How do you keep paying soldiers, Social Security beneficiaries, doctors, and contractors when markets are demanding higher and higher yields to roll over your debt? Within a couple of weeks, the shock would spread from finance into the real economy. Companies that depend on short-term funding might struggle to make payroll. Pension funds could see sharp paper losses. Governments at every level would cut or delay spending. International trade, priced and settled in dollars, would slow as buyers and sellers argue over what the U.S. currency is actually worth in a world where its government just broke the most important promise it has. And yet, the core of the crisis would not be about spreadsheets or accounting tricks. It would be about belief. The United States doesn't just issue currency, it issues trust. For decades, investors have treated American debt as the closest thing to a sure bet that exists. If that faith is broken, there is no central bank big enough to simply print a new one. History offers a warning. Rome had the silver denarius. Britain had the pound sterling. Each empire discovered the same hard rule. A currency lasts only as long as people believe in the power and stability behind it. When that belief erodes, even coins made of real metal can lose their meaning. In the modern era, where most money is just numbers in a database, the process can move even faster. In a U.S. default, the collapse would start in the data feeds and the quiet emergency calls, not in the streets. But eventually, it would reach ordinary people as lost savings, higher prices, and fewer opportunities. The world would begin, slowly but decisively, to detach itself from the American-centered system, not out of hatred or revenge, but out of basic self-preservation. Some imagine that another great power, like China, would quickly step in and replace the dollar with its own currency as the new anchor of global finance. In reality, trust on that scale cannot be conjured overnight. It takes decades of consistent behavior, open markets, and credible institutions. If U.S. debt lost its unique status suddenly, the likely outcome would not be a clean handoff to a new leader. It would be a messy period in which no single currency is fully trusted, and every cross-border transaction becomes more expensive because no one is sure which promises will hold. That is what default really means at the deepest level. It is not just failing to pay a bill. It is breaking the story that everyone has been using to make sense of value. For nearly 80 years, the story has been that the American system, its laws, its democracy, its central bank, and its debt, will survive any crisis. That story is what allowed nations to save in dollars, companies to borrow in dollars, and individuals to trust their bank balances. If that story dies, what replaces it is not immediately a better story. For a while, it is just noise. The irony is that such a disaster would not happen because the United States literally ran out of money. The U.S. government issues the world's primary reserve currency. In a narrow technical sense, it can always create the dollars it owes. The real danger comes from something less tangible: political paralysis and complacency. If ideology and partisan warfare block the basic functions of government, if leaders allow the world to even suspect that paying the debt is optional, markets will not patiently wait for explanations. Confidence does not care why the check bounced. It only cares that it did. We have already seen warnings. The 2011 near breach of the debt ceiling, the 2013 government shutdown drama, the 2023 standoff that forced the Treasury into extraordinary measures. Each episode left a small scar. Rating agencies adjusted their views. Investors added tiny risk premiums. Central banks diversified just a little bit more. On the surface, the system kept working. Underneath, the trust that makes it possible thinned, one layer at a time. Meanwhile, the arithmetic of the debt itself grows more uncomfortable. When a country spends more each year just servicing past promises than it spends investing in future growth, something is out of balance. The danger is not that the math suddenly stops working on a specific date. The danger is that political leaders and voters start to assume that, because the system survived the last crisis, it will survive every future one automatically. History suggests the opposite. In the late stages of great powers, money often becomes a temporary patch for deeper problems. Governments borrow and print to avoid hard choices, until the cost of maintaining the illusion overwhelms the benefits. The United States is not at that final stage yet. Its economy remains enormous. Its institutions, though stressed, are still functional. Its currency is still dominant. But it is walking a familiar path, relying on reputation and habit instead of actively protecting the trust that underpins its financial power. A true U.S. default would mark the end of an era, not just because the numbers on the screen no longer add up neatly, but because the underlying narrative would break. The world would no longer be able to tell itself. No matter what happens, the U.S. government will honor its debts. In place of that certainty would come hedging, fragmentation, and eventually indifference. Countries would not loudly revolt against the dollar. They would gradually build systems that simply do not need it as much. That is how empires fade in the modern world, not in a single collapse, but through a steady loss of centrality, not with dramatic declarations of a new order, but with millions of quiet decisions to diversify risk. The greatest danger to the United States is not that it will suddenly default tomorrow. It is that every year of political games around the debt and every decade of rising obligations make a future loss of faith more likely. The United States built an empire of finance on a striking paradox: theoretically limitless debt backed by something intangible but incredibly powerful: global trust. For now, that trust still holds. Investors still buy treasuries, central banks still hold dollars, markets still behave as if U.S. default is unthinkable. But trust, like any resource, can be overdrawn. If the day ever comes when the United States truly cannot, or will not, pay what it owes, the consequences will go far beyond a missed coupon payment. It will be a default on its own story. The idea that a nation could rule by confidence, finance its dominance with promises, and never face the reckoning that history has brought to every great power before it. Because beneath all the charts, spreadsheets, and interest rates lies one simple, unsettling truth. The world does not actually run on money. It runs on trust. And trust is the one currency no country can afford to waste.